Welcome to The Explainer. Today, we're going to demystify one of the most powerful and maybe one of the most misunderstood concepts in personal finance, the 4% rule.
So here's our game plan. First, we're going to talk about that feeling, you know the one, of being financially stuck. Then, we'll calculate the exact number you need to be free. After that, we'll build a plan to get there, look at the common traps to avoid, and finally, we'll talk about the mindset you need to actually see this all the way through.
Okay, so let's just dive right in. It all starts with the feeling that, honestly, is probably way too familiar for a lot of us.
I mean, that quote just hits the nail on the head, doesn't it? And listen, if you feel this way, it is not a personal failure. It's almost by design. We live in what some people call an extraction economy, and it's built to to take tiny amounts of money from you so frequently that you barely even notice it's happening.
And if you think it's just you, check this out. It is shockingly common. I mean, this is wild. Data from Goldman Sachs shows that 41% of people making over $300,000 a year, they still feel like they're living paycheck to paycheck. It's incredible.
So what gives? How do you actually close that gap between making good money and truly building wealth? Well, the answer isn't some secret stock tip or a complex strategy. It's actually just a number. It's your number.
And that brings us to the really fun part. This is where we take that big, kind of vague dream of financial independence and we turn it into a simple, solvable math problem.
So what is the 4% rule exactly? Well, it comes from this landmark study by a guy named William Bengen. He looked at nearly 70 years of historical market data to figure out a safe withdrawal rate. Now, it's a super powerful starting point, but you got to remember, it's a guideline based on history, not some ironclad guarantee for the future.
And the best part? It all comes down to this incredibly simple two-step calculation. First, you just have to figure out roughly what you'll spend in a year. Then, you just apply the formula. That's it.
And here's what it looks like with real numbers. Let's say you need $50,000 a year to live on. Your target is $1.25 million. You need $100,000 a year, then you're shooting for $2.5 million. This right here, this is your freedom number.
Okay, so you've got your target. Now, how in the world do you actually get there? The answer lies in what might be the most powerful force in the entire universe of finance.
And get this, it's not always about landing that one huge win. A lot of the time, it's about avoiding thousands of tiny little losses. The average household leaves potentially $1.6 million on the table over a lifetime. From what? From all those little things. Eating out, that gym membership you don't use, impulse buys. It adds up big time. You know, our own emotions can be our worst enemy. This Dalbar study is fascinating. It shows that investors who try to jump in and out of the market, well, they earn way less than if they had just bought and held. We're talking about a $1.28 million gap. That's the cost of letting fear and greed take over.
So the path to your number isn't about complexity, it is all about consistency. These habits are the engine. I mean, capturing your employer match, that's an immediate 100% return on your money. You're never going to find that anywhere else. And then you automate everything. You take willpower right out of the driver's seat and build a machine that works for you.
All right, but as your wealth starts to grow, some new challenges start to creep in. So think of this next part as your field guide to the most common pitfalls you need to sidestep.
Okay, the absolute biggest threat is lifestyle inflation. You know exactly what this is. You get a raise, you get a nicer car. You get a bonus, you start looking at bigger houses. The choice here isn't really between a good life and a bad one. It's between a slightly nicer car today and total financial freedom tomorrow.
And this leads right into another classic trap, being asset-rich but cash-poor, right? You look great on paper. Your net worth is high, but almost all of it is tied up in things you can't easily access, like your house. That's not very helpful when a great opportunity or, an emergency pops up.
And please do not forget about taxes. Think of taxes as your single biggest expense in retirement. So managing them by using a mix of accounts, taxable, traditional, Roth, it's not just a small optimization. It can literally save you hundreds of thousands of dollars. It's a huge lever you have direct control over.
And now for the final and maybe the most crucial piece of this whole puzzle, learning how to master your own psychology when the markets inevitably go crazy.
First things first, you have to understand deep in your bones that market crashes are a normal, predictable part of investing. They're not some rare black swan catastrophe. They're a recurring event. They're a feature, not a bug.
And the math behind panic selling is just brutal. A 40% loss doesn't require a 40% gain to get back to where you started. Nope. It requires a 67% gain just to break even. When you sell at the bottom, you are digging a hole that is incredibly difficult to climb out of.
I mean, this quote from the legendary investor Peter Lynch says it all. His fund averaged an insane 29.2% annually. And yet, many of the people in his fund still lost money. Why? Because they'd get scared, sell at the bottom, and then jump back in after all the gains had already happened. It's the ultimate proof that your behavior is so much more important than your portfolio.
So what's the antidote to all this? It's automation. It's taking your own emotions out of the equation. By investing a fixed amount regularly, you automatically buy more shares when prices are low and fewer when they're high. You turn scary volatility into your biggest advantage. A market crash just becomes the biggest sale of the year.
So ultimately, the whole path to financial freedom really comes down to how you answer this one single question. Your preparation, your mindset, that's what determines whether the next downturn sets you back or actually launches you forward.